Hello everyone, welcome to Afsara 24/7. My name is Niharika Walia Bhatnagar and I'm with you with the specific area of ABFM, that is Advanced Business and Financial Management. I hope you're all doing fine, everyone. Okay, good morning and please share the session, like the session, and don't forget to subscribe to the channel if you haven't done it yet. Chaliye, let's begin with the session, everyone. What am I going to talk about today? We were discussing capital budgeting, so I'm going to discuss concept of the day with a specific case study. Okay, so please pick up your calculator so that I can discuss both the question as well as the further detail of it. Okay, chaliye. Let's begin with this part, everyone. We're talking about capital investment decisions. What do you mean by the term capital investment decisions? The decisions that we take in terms of buying an asset, investing in one asset or the other. When we are determining these things, then that is covered here. Done? Let's talk about this in detail. What is the concept of the day? Let's talk about the concept of the day, everyone. What's the concept of the day? In the last class, I talked about payback period. Do you remember that part? In this case, I'm going to talk about another non-discounted method, not the discounting one, non-discounted method. Chaliye, let's talk about that method as well, everyone. Concept of the day today is accounting rate of return. What is the return that you are getting in the business? Obviously, every business wants to know what is the amount that they will get in return. If I get a good return only, then I'll put money into the business now. Practically, that is where we do that. Otherwise, why would I put money into something? This part is called accounting rate of return. If you look at the area of accounting rate of return, this is the formula which reflects your rate of return, whatever your return you are getting because you invested money in this, right? You are compared to the initial investment cost. Now, this method involves estimating revenue and expenses for say over 3 years and to find out the average rate of return which can be considered as the rate of appraising the investment. You're going to increase the investment further now. If I say that I want to increase my investment, I should be getting enough money so that I feel motivated कि अरे नहीं, I'm getting good money from this business already. I think I should invest more. That particular thing comes out of this area only na. Now look at this. Accounting rate of return can be defined as your average annual income divided by investment. If your income on an annual basis is 1 lakh and you invested 10 lakh rupees, then you give it in percentage. That is your 10%. This is how you define the specific area. Done, everyone? This is how we define the accounting rate of return. Higher this particular return, then that particular thing would be chosen up. Reason, you get more returns, so you definitely look forward towards that particular area altogether. Okay, let's look at the next point. This method scores over the other methods because this is a little better method. This is one of the best methods. The discounted cash flow method calls for estimates for the entire project. Payback period just looks at the period in which we can recover funds. This method takes over overall whatever money you're making. We find many assets outlive the rated life. There are certain assets which are beyond that particular area even. This is better than discounted one even. In the longer run, in the books of accounts, if you see good money, then only we can say no. The estimating money is basically you're just calculating it. Ki maybe this would be the money, maybe this won't be the money. This can turn out to be unreal. And this method uses a limited data but is based on accounting information readily available and familiar to the business community. Done, everyone? Now, let's talk about the next point. These are the basic reasons why this method is better. Acha, everyone, pick up your calculators because now we're going to do a specific question from our book itself. How do they deal with this specific issue altogether? Done? Okay. So let's talk about this topic in detail. Done? Now look at this question. Suppose A Limited is going to invest a sum of 3 lakh rupees having a lifespan of 3 years. They have a lifespan of 3 years and their salvage value is 90,000. Matlab 3 lakh is the value of the asset minus 90,000. That is what you are getting out of it. The profit before depreciation for each year is 1,50,000. Matlab you earn 1,50,000 as your profit before putting the depreciation. How do we calculate depreciation, everyone? Cost minus salvage value divided by number of years. That means you have 2,70,000 as the depreciation total. Divide by 3 years, that means rupees 90,000. So in this case, it is going to be profit before depreciation is 1,50,000. You're getting 1,50,000 as profit before depreciation. Now in this case, oh sorry, this is 2,10,000. This is 3 sevens are 21 and you get 70,000 here. Hai na? Acha, look at this. I hope this is visible clearly now. You have got 3 lakh minus 90,000. The formula that I used was cost minus salvage value divided by number of years. 2,10,000 divided by 3 giving us 70,000. The profit after tax and value of investment in the beginning and at the end of the each year is going to be this. Depreciation charged, profit before depreciation was 1,50,000. From this 1,50,000, remove your depreciation. What you're left with is profit after depreciation. Once you have got the profit after depreciation, then they say what is the value of the investment. This is given. In the beginning we had kept 3 lakh rupees, then it became 2,30,000 after depreciation, then it became 1,60,000. By the end it is just 90,000. है ना? That is the point that they're saying. For the first and second and the third year, the depreciation is 70,000 for each year. So if I put 3 lakh into something, by the end it is just now at 90. Now there are different versions of calculating it. One part was your profit divided by your initial investment. In this case, we do it slightly differently. This is annual basis. What do you mean by annual basis, everyone? We're just making it every single year, it's going to be different. That is profit after depreciation divided by investment in the beginning of the year. That means you pick up your profit after investment. That means what you're going to pick up? 80,000. This is your 80,000. For the first year, you have 80,000 divided by what is the amount of money that you have invested? 3 lakh. In the second year, it is 80,000 divided by 2,30,000. In the third year, it is 80,000 and divided by 1,60,000. What are they picking, everyone? They are picking the investment value in the beginning of each time that they're picking up. That is, beginning is the investment area that they're picking up. Beginning is 3 lakh, 2,30,000, and the last one is 1,60,000. Visible, everyone? Now let's look at the next part. This is 80,000 divided by 3 lakh, 80,000 divided by 2,30,000, and 80,000 divided by 1,60,000. Find the percentages as well. First is 26.67. What have they done? They took the profit after depreciation divided by beginning wala portion and they multiplied it by 100. That is why it is in percentage. First year, second year, and third year. This is individual. Done? This is the first method. Now look at the next method. This was the first version. Second version to it is version 2. What do you mean by the second version, everyone? They are taking not this part. Now they say, we will not take up individual years. Let's take up all the 3 years together. That means total investment basis. Total investment basis means take up your total profit and total profit converted into average, and then divided average annual profit divided by only the investment in the beginning. How do we find the average, everyone? It is going to be 80 plus 80 plus 80 divided by 3. That means my average investment is of 80,000 and divided by the initial investment that you have made, that is of 3 lakh rupees. So this would be 80,000 divided by 3 lakh. Acha, writing it over here now, everyone. 80,000 plus 80,000 plus 80,000 divided by 3. That gives us total 2,40,000 divided by 3. Again, the amount comes out to be 80,000. That means the value is 80,000 overall. You pick up that 80,000. This is your profit. Profit divided by 3. Okay, total profit divided by 3 and divided by 3 lakh. That is your investment in the beginning. multiplied by 100. This has to be in percentage. Accounting rate of return is always in percentage. Everyone think about it. Here we had seen that good point here, but I think if I go by the third year, I am just investing 1,16,000 getting 80. But where's the depreciation consideration? It should be there now. So in this case, first year we had 26.67, then increasing it to 34.78, increasing it by another good percentage, it is turning into 50%, huge amount. Total investment basis, it is average annual profit divided by investment in the beginning. You've got it, and it comes out to 26.67%. Done. Now let's move on to the next point. Okay. Let's move on to the last version. The last version is your average annual profit divided by average investment. Everyone, whenever we are trying to find average, normally average investment is opening investment plus the closing investment divided by 2. Matlab I could have taken 3,90,000 divided by 2. But the point is, in this case, we have it as a salvage value. It is the residual value which would be left after 3 years of using it. It would be of 90 and we'll sell it off. In this case, what will we do? We will use the term half. Then whatever your initial investment is, you spent 3 lakh, yes. Then whatever your salvage value, whatever you'll get after 3 years, plus the salvage value. You will get this much amount of money, and you are taking the average of whatever money your investment is into the business for all these 3 years. You said you are putting money, you spent 3 lakh rupees. From that 3 lakh, remove that 90,000 that you will recover in any case. You have spent 3 lakh into this and you will recover 90. So technically your amount which is staying invested is 2,10,000 only. Then 90 something you will definitely get back. So your total investment is what? 1 lakh of half of 2,10,000 plus 90,000. That makes a total. It is 2,10,000 divided by 2, 105 plus 90, making it 195. If the total is 1,95,000, then 80,000 divided by 1,95,000 into 100, giving us 41.03%, everyone. This is the one. See, in this case, I think I can see the maximum price, a maximum accounting rate of return. Done now? This was the concept of the day, a specific question on accounting rate of return. Chaliye. Now everyone, put an end to the session, but before I end the session, there are certain things that I would like to discuss. Go to our website www.247.com. Go on to the area of CAIIB June 2024. Everyone, our case study batches are out. You can see our English medium case study plus Mahapacks revision batches out. If you are planning to purchase our courses, then